You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, happy 2023 to everyone out there. This is the first Options Playbook Radio of the new year. We are taping on the 4th of January. It is a Wednesday. The markets are closed. S&P 500 index closed up around 29 points at 3,853-ish. Got the VIX index trading right around 22. And the Dow and the NASDAQ were up approximately the same amount as the S&P 500 index. And right now we are going to get bearish on the markets. We had the Santa Claus rally kind of just peter out going into the new year. Very uneventful time after the Christmas holiday, after the markets were closed. A lot of times up until today, actually, is how they judge the Santa Claus rally on the close as of today. But with that said, the markets were up just a smidge from the Christmas holiday until the new year. Nothing to write home about. So I guess you could say by definition, the rally was intact and that the market was up a bit. But there just really was a lot of chop in the marketplace. And the S&P 500 index is just hanging right around this level, 3,850, right in that range. 3,800 seems like it's hard for it to break to the downside, but also very hard for it to get above the 4,000 on the upside. So if I had to guess, going into the end of January, I would say the path of least resistance would be to the downside. That's if I had to guess. But with that said, that nothing that we do here is meant to be a recommendation. I'm just saying that as far as the markets are concerned, there are a lot of headwinds. One of the biggest headwinds is the fact that I can go on over to the 2-year Treasury market and I can get over 4% yield on my cash funds without any risk by investing in treasuries. If I want to go up to the 10-year, I'm looking at about 3.7% on the 10-year. So it's hard to even find stocks in the S&P 500 index that have dividend yield that can equate to where the treasury market is at. So that makes a lot of headwinds as far as the marketplace is concerned, because if you have new capital that you want to allocate in the marketplace, well, why not consider some of these risk-free instruments, considering that the Fed came out and they released their notes today from their meeting a couple of weeks ago, and everybody is still very hawkish in the Fed. All the examiners across the board, actually 17 out of the 19 still feel like the terminal rate will probably be somewhere above the 5% level for the Fed funds. Just two of them were below the 5% level, but none of them, and they actually made a point to reiterate that they do not see any potential for rate cuts going into, well, throughout the whole year, basically. And they just want to make it clear that that is their outlook. They do not want to cut the Fed funds rate anytime soon, and there are no plans to do so. And the market, I don't know, I kind of reacted just blah to that news. And once again, we finished up just a little bit today. We have earnings season coming. I think that a big thing's going to be with all the earnings that are kicking off here in a week or so. We're going to see guidance get cut, and how much they cut and what they say after this round of earnings, which I actually don't anticipate for the numbers to be really bad. I think a lot of people are just going to be weighing on the guidance that a lot of these companies are giving. And most of them are giving guidance. We ran into a situation around the COVID times where a lot of companies just said, well, we're not going to give guidance. So they just punted that ball down the field. Nowadays, we're back to the mode where they're willing to give that type of guidance, but we're seeing layoffs get a little heavier right now, and it's kind of a good news, bad news situation in that the Fed would really like to see the wage growth kind of wane, would really like to see unemployment to go up a little bit for them to be less hawkish on their stance in the marketplace. But if that does happen and it happens too quickly, well, then it could push us into recession. So the jobs market is taking a lot of the blame for the amount of inflation that we've had recently, the jobs market being so strong. So it is a stock picker's market right now, and it just makes it really tough to try to come on out and say, I'd like to pick this stock over that stock. If I were trading stocks, and I've done this a lot over the last quarter here on Options Playbook Radio, just talked about buying deep into money calls as an alternative to buying the stock outright. So I just want to get bearish just because I want to see kind of how the next couple of weeks play out. And I'm going to get bearish very short term here going into the end of the week. And we're going to look at a SPX put butterfly, which is my bearish trade when I don't know what else to do in the marketplace. I mean, ideally, if you're just going to do something for a year with a year time frame, I mean, I don't know why you wouldn't be looking at treasuries or even CDs from banks. Even CDs are at very good rates. You can buy 1-year CDs right around 4%. So I don't know, as far as the short term is concerned, why you would want to take a lot of the risks in the marketplace. Now, with that said, it's also a buying opportunity. You want to buy the dips. You'd like to stay with your plan if you have a longer term outlook. Obviously, you don't want to be messing with your 401ks. I'm sure a lot of people are a little bit nervous about that. But if you're continually dollar cost averaging into the market, you're buying more shares of whichever mutual fund or ETF or whatever that you are trading because the markets are down, but you're dollar cost averaging into the markets. So longer term outlook, you just want to stay the course. Short term, I think the path of least resistance is to the downside as opposed to the upside. We're going to have a tough first quarter here. Really want to get into the March, April months before we actually, might see a little bit of a pop to the upside. Don't see any movement. If I were to predict anything, I would predict chop. I wouldn't be surprised that a month from now we're trading right where we're at, and with a lot of volatility involved, right around that 3,800 level. But okay, so VIX index, 22. Love the VIX index being at 22. When the VIX index is around that 22, 23 level, in this day and age, that would be considered, I guess, on the low end of volatility ever since since the pandemic. So with that said, it makes it interesting to do index options because you have some volatility and some predictability. And that's where I like to look at butterflies and condors. So we're going to just literally get short the SPX going into Friday. And the trade that we're going to look at with the market at 3,852.97, to be exact, I'm going to round that up now to 3,853. We're going to take the just out of the money put option, and we're going to go to this Friday's expiration. These option contracts are going to expire after the close on Friday, January 6th. And because the VIX is high, this is going to be a fairly inexpensive butterfly. And I mean, it's not like the VIX is outrageously high in this environment, but it's still above 20. And when the VIX is above 20, there's going to be a lot of premium in the S&P 500 index options. So we're going to be buying that January 6th, 38.50 strike put, going 20 points down, and selling two of that January 6th, 38.30 strike put. And then our protection would be to buy that same expiration 38.10 strike put. This is a 20-point wide butterfly. And even with 2 days remaining to expiration, 2 full trading days, because the market is closed right now, we can buy this 20-point wide butterfly for a net debit of $1.90 at the midpoint right now with the market's closed. So $190. The maximum that this could trade for is $2,000 or 20 points. And that would mean that right at expiration, it went out right at that strike price, that center strike of 38.30. That's the only way you'd receive the maximum on this trade. So ideally, if I'm putting this trade on, I'm paying $1.90 for it. If we do get a downturn tomorrow morning or in the afternoon, I'm looking to just basically double on my trade, paying $1.90 for the trade. If I could sell it for $4, close to $5, I want to get out of the trade. I'm not going to hang around, especially if I get the down move tomorrow. Now, if the markets just kind of chop around, well, I can hang around. And then on Friday, the potential, you get one more day's worth of time decay in there. And if you're correct on your forecast, you want time to erode. You want those option contracts that you sold to go away as much as possible, to wither away. And so ideally, you would be correct in your forecast down to the 38.30 level, closer to that Friday expiration date. But I always kind of just judge it based off of the actual price of the option contracts. Now, I put this trade on, and tomorrow, instead of the market going down 20, we see the market go up 20 or maybe even 30. You could potentially roll this into a short put spread. You're going to sell the most expensive option contract, the 38.50 strike put, and you'd use the proceeds to buy the least expensive option contract, which is the 38.10 strike put. You're going to bring in a decent net credit to the account, but you're going to add a lot of risk to the account too by doing this. But that is an alternative. We go from a butterfly into a short put spread. We would create a 2x2 short put spread, so the risk would be substantial because we're 20 points wide. That would be increase your risk of $4,000 on this trade as opposed to what we paid for it, $1.90. But if the market's going north, the main reason why we would do this is the market has gone up. And we would then be quite a ways away from our short to put strike, and that would be our alternative. And I'll look at this trade and I'll watch it. I'll paper trade it right along with you and see what happens mainly tomorrow. On Friday, if the market hasn't moved at all, well, on the open, I may just get out of the trade. We'll see where the market is at. And but my hedge or my adjustment would probably be somewhere close to the close tomorrow, and you would look at that adjustment, rolling that into a 2x2 short put spread. So let's do this little summary. One of my I guess you can't really say you have a favorite, but if I'm looking to get bearish on a particular index and we got higher volatility, butterflies are definitely interesting. So it's once again, Options Playbook Radio is all about the conditions of the marketplace and the pricing of the options. And because we still have the VIX above 20, and I don't see that going away anytime soon, you're going to get extra juice in the S&P 500 index options, which is based off of the VIX. That's what the VIX index is based off of the options that trade in the S&P 500 index. So with that said, we can put this butterfly on for a cheaper price, even though it only has 2 days remaining until the expiration. So we're looking with the market at 38.53. We're going to buy the January 6th expiration, 38.50 strike put. Sell 2 of that same expiration, 38.30 strike puts, and then buy 1 of that same expiration, 38.10 strike puts. This is a 20-point wide butterfly. Right now, the midpoint for that butterfly is $1.90, implying that if we do a 1 by 2 by 1 butterfly and fill at that price, our maximum risk would be $190. Now, if the market did go up and I could sell this for a decent credit where I would roll the 38.50 and sell that to close and buy to open the 38.10, I would be looking to bring in at least a net credit of around $5 or $6 to the account. And this is kind of, I don't want the cheese anymore. Just let me out of the trap. The market's gone against me. I have a lot of risk. I'm going to have to manage that trade. But if I did that, now I'm going to bring in a net credit of more than what I paid for the butterfly and basically just give me a chance to get out of the position at a small gain, or decent gain overall. But I'm going to have to watch closely because if the market does start going towards my short put strike, I do want to close that trade out and not hit the max risk. All right, that's it for this episode of Options Playbook Radio. Happy New Year to everyone. If you have any suggestions for the show, we want to hear them. Actually, Mark Longo and I should get together and do a huddle up and just try to hear your suggestions on what you'd like to see in the new year. This has been many years of doing Options Playbook Radio, and thanks to your support, over 2 million downloads last year. So definitely appreciate all the support from all the listeners out there. And if you have ideas, you can email them to me directly at theoptionsguy@invest.ally.com. Follow me on Twitter if you want to hear about all the educational events we do over here at Ally Invest. And as always, we'll see you same time, same place next week. Until then, may all the options that you bought finish in the money and all the ones you've sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.